Well, we finally got the pullback we expected in August, and volatility hits an all-time high. The question is the market going to rebound back in a very positive way like it did back in October of last year, or is this the beginning of the next bear market? Where's the market going? What's causing all this volatility? And even more importantly, what should you do with your money? I'm going to answer all these questions in my monthly market summary for August 2015. Now, if you watch my video from last month, I drew this line here at 2100 on the S&P 500. And if you can actually count the number of times that it actually crossed up and down this number, I counted 19 times before this huge pullback last week. And basically from intraday low at 1867 to the all-time high was about 11 to 12% pullback on the S&P. Now, we had big rebounds last Thursday and Friday, and then the last 2 days, we've actually had another big pullback. So I'm recording this on September the 1st, and we've had a very bearish day right here. So what I want to show you is more of a longer-term perspective. So I want to go on a 5-year weekly chart and kind of show you the big picture. So I drew this support line here at 1800, which that's where intraday the market dropped last October, and it also coincides with this support level back in April of last year. So if the market drops and punctures this 1800 mark, that is a truly bearish sign, and it's very close to crossing that 200-day moving average. And so we're not there yet, but again, this is roughly a 15% correction. And those are not unheard of. We've seen this before. Actually, if we go back to 2011, you can see that's the last time we had a pullback of that significance. And you can see right here, it started in right about this same time of year, back in August of 2011. And the market continued to be down for quite some time. You can see that the RSI really dropped again. We want to see the RSI above 50. And back in 2011, it really dropped and got down to this 30 mark, which is very bearish. And we can also see back here the intermediate market forecast went from very bullish to also very bearish back in that time. And so here we are today at roughly 37.38 on the market forecast on the intermediate, and we had to go all the way back to 2011 to get there. So, quite frankly, these are very normal things where, a 10%, 15% pullback is certainly very normal. Just no one likes to deal with it when it's happening. So, one of the things I want to show you was also the VIX, the volatility index. And you can see, again, back in 2011, we had a very prolonged period of high volatility during that period of time. That's when we had that big 20% sell-off back in 2011. Since then, we've had some spikes here and there, but you can see it's been fairly, calm, especially this year. The VIX has been around 13, 14, 15 up until this last week. Look at this intraday peak at 53. I mean, that is just incredible. So the volatility is certainly here. It won't be this high forever, but we certainly see the volatility continuing for some time, considering kind of what's happening in China. The Federal Reserve is going to raise interest rates. We're not sure if that's going to happen later this month in September or later on. So there's still a bunch of uncertainty. So we certainly see the VIX will continue to be volatile. The other thing I wanted to kind of show you was the AGG, which is the bond index. Again, this is on a 5-year chart, and so bonds have just been very volatile. Actually, if you go back last year, it was a pretty good year for bonds. They started low and ended up high. But look where we are in 2015. Again, we kind of peaked here at the end of January. We've really dropped, and again, the bond market's really been kind of trying to second guess what the Fed is going to do. So one thing I can read from this is that you can certainly expect continued volatility in the fixed income markets. So, what I suggest in terms of your bond portfolio, try to stay with higher quality bonds with short and intermediate term durations. That will reduce the risk when the Fed does raise interest rates, and you won't get hit as hard. So this is the bond index. Again, you can see the last few years has been very, very volatile, and again we certainly can predict that to be happening again as time goes on with the continued volatility. Again, I'll show you the TNX, which is the 10-year Treasury yield. Again, this is what your 10-year your mortgages are based off of in your car loans and the main benchmark to borrow money. So now it's still a good time to buy a house, to borrow money for a car, or for whatever. Interest rates are going to continue to be low. They did spike up a little bit this year, but they retreated a little bit. And so, but that is one good thing about the housing market, is that the interest rates haven't spiked to a point to really slow down the housing market too much. That's one positive sign. A couple of things that I'm a little concerned about still is the strength of the dollar. Remember, when you have a strong dollar and you're trying to buy American goods and services, they're more expensive because of the currency mismatches. So just basic supply and demand shows that if you're trying to buy an American good or service and it's more expensive, there's going to be fewer buyers for that good and service, or those goods and services. So therefore, the earnings won't be quite as good, and therefore the stocks will be hurt a bit. And that's one reason why the stocks have been somewhat flat this year, is because of a strong dollar and not being quite as profitable selling to outside the United States. So the dollar continues to be strong, although it's fallen off a little bit. It still remains pretty strong. Another leading indicator that is a little bit concerning is copper. And you can see that copper peaked back here in 2010, and it's just been slowly declining. It just continues to drop. Well, remember, copper is used in wiring and pipes and all sorts of things that are in buildings and automobiles and goods and services that are, new things that are being built. And as the demand for copper drops, that is a bearish economic sign. So this is not looking so good in terms of a leading indicator with copper. The other thing that concerns me, we've just been talking about this to death, is obviously the price of oil. Again, oil peaked back here in 2011 at a little over 45 in USO. This is the ETF that kind of represents the U.S. oil market, and you can see that the trend from the last year has just gone down. Now, we've had a couple days of a rally, but as of today, things are starting to turn over a little bit. Again, this is a weekly chart, so you can see the RSI is far down. The market forecast, I mean, this is just bearish like you wouldn't believe. And now, at some point, we will hit a bottom. I just don't know when that's going to be. And could oil fall more? Absolutely. So it's nice when I go to the gas station to put gas in my car because gas is cheap. However, there is some negative economic repercussions as a result of, well, obviously the price of oil going down, that are sort of causing havoc in the world economy. So the big thing that everybody that's in the news is China. And again, this is a weekly chart, so you can see from mid-March of this year up until the end of April, so in about a 6-week period, look how much the Chinese stock market just surged, and look how fast it has just plummeted back to earth. So remember that this is the beginning of the year, so imagine if you were an investor buying at the top and having this huge drop in your stock prices. So the Chinese economy is not doing well. The stock market is taking a huge hit. Again, you can see a big drop here in the RSI, and that's just not a good sign. And you can also see here the market forecast, just very, very negative. So that's certainly a very, very bearish sign. We look at the transportations. Again, transportation. If your planes and your trains and your trucks are moving goods and services across the globe, that's a good positive economic sign. Well, you can see that the chart is rolled over a bit, and so when the planes, trains, and automobiles aren't doing as well, that's also a bearish economic sign. So let's talk about the NASDAQ. So NASDAQ, although we've had a big drop right here, it's been one of the stronger sectors of the year. And the NASDAQ, as well as the S&P, is driven by Apple. So the chart for Apple stock is very, very similar to the S&P. You can see that, and also the NASDAQ. So you can see that it had a nice run, a little trail off, big volatility last week, but starting to come back. But still, we see on the 21-day moving average is starting to roll over a little bit. The RSI is down, and our market forecast is, again, we like to see it above 80, but right now it's around 63. So obviously, Apple is stronger than other sectors that are out there, but it's still showing some weakness as well. Let's move on to small cap. So small cap, same story. Market forecast looking pretty bearish. Again, we're down around 33. RSI low. MACD turned over. We do have some support right here. I drew this at 104. We're not there yet. But again, if we kind of get around that range, we'll have across the 200-day moving average. Another confirmation of a bear market. So we're not quite there yet, but we are kind of knocking on the door, so to say. So those are some of the things that I'm concerned about. The biggest thing that's kind of getting down in the weeds a little bit. But I wanted to share with you, again, just another thing. This is the bullish percent for all U.S. stocks. And you can see here's 2014, 2015, and we've had lower highs starting in the end of 2014, lower lows, and you can see this big column of O's right here. So that means that the percentage of all the stocks in the stock market that are in bearish territory are very high. Okay, so this is again, you can see that the momentum has certainly turned negative, and we got football season upon us. So again, I'm sure you relate to football and offense and defense. Now's the time to definitely be defensive. And again, the last time we've gotten this low was back here in 2011, which I talked about that just a few minutes ago at the beginning of the video. So we don't know if this column of O's is going to continue to go down and where the support is. Hopefully it won't go as low as it did back in 2011, but that's certainly a possibility. Hopefully we can see some support and things will kind of turn around. But again, when you have the majority of the stocks in the stock market in correction mode or in a confirmed bear market, again, I highlight that right there, that's certainly a bearish sign. So, one of the questions is, so Jim, where do you think the market's going to go down the road? And again, the question is the market going to revert back into a positive trend, or is this the beginning of a longer-term bear market? Well, one of the things this is an article that just came out last week, was the stocks crashed the last 2 times this happened. And I talked about this in my video last month, that's about the very high levels of margin debt. So just to kind of refamiliarize you what margin debt is, when investors buy stocks with money that they don't have, they can buy stocks on margin. That's the money that the brokerage accounts offer them. And when they buy stocks on margin, this drives up the stock prices. And this makes room for more margin debt, as higher stock prices allow investors to borrow even more against this same number of shares. Hey, this is great in a bull market. On the flip side, when stocks tank, already spooked investors may be forced to sell to pay down their margin debt to stay within the limits. So they may get a margin call saying, hey, listen, you need to either sell your stock or fund your account with this money to make good on your margin. So you may be forced to sell your positions, which will actually just continue that momentum downward, which begets more forced selling. So this happened a lot last week when the Dow plunged over 1,000 points. So when you look historically on the margin debt, in March 2000, again, I highlight this stuff because it's important, margin debt hit a record of $278.5 billion just before the stock market started to crash. Again, it recovered, and in the July of 2007, we also had another peak at $381.4 billion in margin debt before the last stock market crashed. And where we are in June, here we are in 2015, we hit another record high of 504.975 billion. And this is even the highest ever margin debt adjusted for inflation. So one of the last chart I'll just kind of leave you with is that when you see the margin debt, and this is at this red line right here, keeps on going up, you can also see it's very, very tightly correlated with the S&P 500. You go back to the last two recessions, when that margin debt starts to turn over and go south, so does the stock market. So you can see that margin debt has really kind of leveled out right here. Will it turn over and start going down? The chances are it will. What will happen to the stock market? That will also drop. So to kind of conclude what to do at this point, now is the time to certainly rebalance your portfolio. The chances are that the market's going to go lower versus higher. And so if you're going to rebalance your portfolio, you want to be in less risky asset classes. If you stay with the overall, large cap stocks, even if you just buy the S&P 500, that's less volatile than many other sectors that are out there. In your bond portfolio, stick with high quality short to intermediate term, corporate bond funds or treasuries. Because remember, the further out the durations are on your bonds, the more they're going to get hurt when the Fed raises interest rates. So the sectors to stay away from, definitely stay away from China. Actually, I want to show you one more thing right here, is kind of where we are with DALI, which is dynamic asset leveling. And again, I've shown this to you before, where we break down asset classes into 6: domestic equities, fixed income, cash, international equities, currencies, and commodities, and we rank them from strongest to weakest. So you can see that U.S. domestic equities are still number 1, and even though they're number 1, they still fail the cash bogey, which means, are you better off in cash or in stocks in the short term? And since the stock market has pulled up back in this negative territory for the year, right now cash is actually outperforming the S&P 500 and U.S. stocks. Now, that won't always be the case, but in the very short term, that is the case. So U.S. Stock market has failed its cash bogey, as well as every other asset class other than fixed income. So what this is telling us is that in the short term, very short term, U.S., international currencies and commodities are all doing worse than if you just had your money in your savings account at this point. Now, you can't keep your money in the savings account forever, because you know that these are going to reverse back at any time. So you can't just put all your money in cash and just keep it there. But what this does show you is that right now it's time to be defensive. So if you concentrate your portfolio in U.S. domestic equities and fixed income, you can avoid or reduce some of the losses in these other asset classes that are much weaker than U.S. domestic equities and fixed income. Okay, so I'm going to leave you with that thought for this month of August. Again, now's the time to be defensive, time to rebalance. If you're a client of mine, if you have any questions about your accounts or anything, I'm happy to talk to you. Just give me a call, send me an email. If you're not a client of mine, I'm happy to review your portfolio. If you just want to email me a statement or give me the positions that you have either in your investments or your 401k, I'm happy to look at them and kind of give you a second opinion on how to deal with stuff. So until next month, I hope this was helpful, and just kind of hang in there. That's the best thing I say. Just again, if you feel uncomfortable, rebalance, get a little more conservative, take some of the risk off the table. But now's not the time to go 100% in cash. If you feel like that you want to do that, certainly give me a call, and I'll be able to kind of give you a better read on what the market's doing. I'll be able to give you a little more of some one-on-one advice. So again, until next month, this is Jim Musgrave with the August market call, and I hope this was helpful, and have a great Labor Day.